Hello guys and welcome to another new learning video. So now by the title you know that we are going to discuss a strategy called 2200 engulfing strategy. So this is the most important strategy so by far because it is a custom made a combination of an indicator and a price action candlestick pattern strategy where this 20 and 200 is the SMA, okay, and this engulfing is the candlestick pattern. So by combining these two we are going to form a strategy and see uh, how it's going to work. Okay, this is the most important strategy because if you are someone who is struggling with the stop losses, this indicator, this strategy is going to come with a proper stop loss and where to take your profits and all. And this is by far the best because it is combining the both the worlds from the indicator side and from the price action side. And it is going to help you trade for this. Usually in most of 90% of the people in the Indian stock market, okay, are not going to maintain their positions for the good amount of time. Initially you might have seen, see, if your average trades are if you are struggling to maintain your average time that you are spending in a trade, if that is your problem, then this is going to solve it because it is going to keep your trade for the longer amount of for the longer period of time. So that's how you're going to obviously make a more money. And because we are involving a moving average indicator, this is the moving average indicator, right? 20 and 200. And because the help, this is excellent in identifying the term, identifying the trend, sorry. So this is an excellent indicator with the trend, and this is an excellent pattern to identify any reversals. So we'll see how this is going to function. So in order to know this by now, you should at least have some understanding about the engulfing pattern. If you don't know what an engulfing pattern is, I request you to watch an engulfing pattern in the link which is left in the description below, because there we have covered the utmost details about the engulfing pattern. There is nothing more that you feel like wanting after seeing that video, because we have discussed the key factors which makes the engulfing pattern stronger. Okay, so before continuing further, I request you to hit the subscribe button if you haven't subscribed to our channel yet. This is the channel where we do everyday post market analysis and learn something from everyday's price action. All right, so now let's get into the topic actually. So now you know that you need a 20 to 100 moving average. So for that, what you need to do is you just simply go into the indicators button right here. Okay, I have already saved it in the favorites, but you can go ahead and select this indicator called SMA by KGS. Okay, excuse me. This is done by Mr. Gomati Shankar. So he is one of the greatest mentors in the Indian stock market. So here we are using an indicator which is named as SMA by KGS. And then what you have to do is, by clicking on the settings, you should come down and you should come to this tab called inputs, and then uncheck these two. You don't need WMA, you don't need exponential moving average, you only need SMA. And even in SMA, because this indicator has you can have five different SMAs, you can have five different EMAs, and you can have five different WMAs. Okay, so if you want to know what is the difference between SMA and EMA, let us know in the comment section so we can come up with a video on that as well. So by far here, so all you need is only two indicators. One is for the 20 and one is for the 200. Okay, so we'll just keep another one, okay, as for just the safety, but we'll not use it. Okay, so either one of this. So what you do is you uncheck these two, okay, and enable only three. Okay, so in this three, the third one, okay, you mark it as red and make sure that you are hitting the last width of the line width so that you can see it better, because we are going to mark this for 200. And this, okay, mark it as blue, and then select a medium, a third one or the second one of line weightage according to your convenience, but don't select the first one. I'll tell you why. Okay, so right now selecting the second one here for this one. And for this, you select any color like a lighter green, yeah. Okay, and then let this be the thinnest out of all these three. So now we have three colors selected and three line widths selected. Now go to the inputs. Okay, now give the first one as 9, and your second one as 20, and your third one as 200. These settings are very important. If you mess up with the settings, then I can't help you, but you need to have these settings. So now you have this has 20, this has 200, and this has 9, right? Yeah. So for time being, you just unselect the 9 and keep only these two, 20 and 200. Now press the OK. All right. Now you should be able to see the indicators. Okay. See, here we have the indicator. Now if you uncheck the one, okay, if you go to the settings and if you just check this one, the first indicator, now you will be able to see the first line as well, which is nothing but 9. This is a, a length of moving average with a length of 9, which means that it is taking average based on the 9 previous candles. So what is a 20 period moving average? Nothing but it is a average taken by the close, okay, for the last 20 candles, and it is dynamically updating, so it is called a moving average instead of an average, and this is a simple moving average. Okay, and this is a 200 period moving average. If you want to see what they are, you can also click this settings button right here, okay, and then go to the labels and then say symbol name label, and here you see indicator, financial indicator and financial name labels. If you enable that, see, you now you are able to see SMA2 here, SMA2 here, you are getting the name of an indicator. Now what should you do is, okay, you can select that as well, so it will even show you the values highlighted there. So for those who want to see that, okay, can enable that. Otherwise, you can, it's if you're good, see, now by unchecking that, you see that that's gone. Okay, so this label on the price is gone. So now I'll just take this one off. Okay, so now the reason behind we have selected blue and red is because they are they can be seen both on the white color chart on or on a black color chart. So most of you might be also see, according to, I don't know who, what's your preferences, but it's better to keep a white chart because that's predominantly high on your eyes, and it keeps you focused on the chart. But those who are used to see a chart like this on a black color chart, so even here you can see that this blue and red and also the green line are going to visit. Okay, see, they are, see, they are visible on both the charts. That's simply the logic behind these colors. If you are comfortable with any other color, you are okay to change the color. So now we have this marked. Okay, so now we have this marked. So coming to this strategy, we have two different scenarios in this. Okay, we'll go through this pattern slowly. We'll go through this strategy slowly. So the aim is to make you understand and make use of this strategy to its best in the live markets and get benefited out of it. So in this we have two scenarios. One is the bullish scenario. Okay, so in this bullish scenario, we have certain rules. We have different rules for bullish and bearish. So please play attention while you watch, so that if you want, you can also take some screenshots for your reference. All right, so here we have the bullish scenario. In the bullish scenario, what you want is, write down this order. So you need to have a price first, and then you need to have the 20 SMA, and then you need to have the 200 SMA. So this is the order. So in order to excuse me, so in order to make this work in a bullish scenario, you need to see this order, which means you need to see the price first. After that, you need to see the 20 SMA, which is this. You need to see then the 200. So in this order you should see if you want to take any bullish trade. You cannot take a trade here. Okay, you cannot take a trade. Okay, wait a minute, this is looking little. Okay, let me enlarge it so that those, for those of you who are watching it on the mobile also, will be able to see these numbers. Okay, so now you cannot take any, this is invalid. Okay, this is invalid if you have a price pattern like this, because first you have the 200, and second you have the price there, and third you have the moving averages. So this is not the right order. So you make sure that you are in a right order. See, so for example, here this is an ideal situation. When the prices are here, this is an ideal situation, because here you have the price first, and then you have the moving average right there, and then here you have the 200 period moving average, and again here it is not going to be a valid, because whenever you have price under your 20 ma 20 sma, then this is an unvalid strategy. You're not supposed to use this strategy in that situation. You'll be using this strategy only when you have all these three elements, whenever they are in this particular order, only then it is useful. See here for example, it is all these prices of the bank nifty is at number 1 level, this is at number 2 level, and this is at number 3 level. So here in this case it is valid. So make sure that in order to take a bullish trades, you the only rules are, okay, you need to see all these three elements in this order. Okay, so in this you have price first, and 20 sma next, and then 200 sma next, and then you need to see, the engulfing pattern. You need to see the engulfing pattern. Okay, so just to give you a very brief explanation what an engulfing pattern is, you need to see a two candle setup. Okay, you need to see a two candle setup. Okay, if it is bullish engulfing, then you need to see a bullish engulfing pattern. You need to see two candles, and you are where your first candle should be a red candle or a doji candle. So in this case you need to have this. So if this is your candle setup formation, where your real bodies and the wicks doesn't matter, your first real body should be smaller and different color, and your second real body should be in a green color if it is a bullish engulfing pattern. Okay, irrespective of their wicks. Okay, so if that is a wick, okay, then it's absolutely okay. Excuse me, because okay, so if this is the pattern, and if this is the candle, okay, and if that is your say shadow or a wick of this candle, it doesn't matter. The only thing that you should take into consideration is your a real body, not the shadows of a candle. Okay, so here in this case, let's assume that these two are the candles. Okay, I'm extremely sorry because I'm used to press the space button. I don't know why. Okay, whenever you do that, it's changing. So now coming back, these are the two candles. So now this is called an engulfing pattern, bullish engulfing pattern. Okay, so now when this bull, you cannot call anything. See, if you see candles which are coming after a sideways momentum, and then if you see it, you cannot call it a bullish engulfing, for which you need to see a downside momentum, after which if you see this, then it is called a bullish engulfing pattern. So all these details are explained in our engulfing pattern video. That I think that's going to give much more information, because that is going to take at least 20 minutes to explain on what a complete bullish or bearish engulfing patterns are. Okay, so now this is an engulfing pattern. So if it is vice versa, if your first candle is green and the second candle is red, which is coming after an uptrend, then it is called a bearish engulfing. So in engulfing patterns, we are not concerned about the wicks or the shadows. I'm telling you once again. Okay, so I'm just taking this off. So now you have, I assume that you have a fair idea on the bullish engulfing pattern. But to unlock the full potential of the bullish engulfing pattern, I request you to watch that video. So now, and the last criteria is you need to see an engulfing pattern, okay, which should be close to the 20 SMA or touching the 20 SMA. All right, that's it. Very simple. So in order to take a bullish trade, first you need to have 20 and 200 SMAs. Okay, see, it's not necessary that you only take this indicator. Okay, there are other indicators also in the see, all you have to type is double moving. There is something called double moving average. Okay, if you want a triple, you even have a triple moving average, I guess. Yeah, there are some triple moving averages, but the reason why I selected this is because it has the maximum number of averages. We have 15 averages. We can plot 15 averages by using that indicator. So now we have this indicator back, and all we have, all for the bullish scenario, all we need is this. Okay, so now let's look at what scenario of the bearish engulfing is. Simple, nothing. All you have to do is just change the order of this. That's going to be the bearish part. Okay, but before discussing a bearish part, let's first check on a real time. See, this is the bank nifty chart, which a recent bank nifty chart, that is December 15, 2023 chart, where we have this situation. Okay, so now you see, now you tell me where is the engulfing pattern. So here in this chart, according to me, okay, this is an engulfing pattern. This is an engulfing pattern. These two candles, 1325 candle and 1330 candle, these two candles put together is called an engulfing pattern. Now you might ask, they see the initial, the first candle of these two is not red, but if the first candle is doji, it doesn't matter. This is a doji candle formation, which is called a dragonfly. So in this case, if your first candle is doji, even in that case it can be taken as a bullish engulfing pattern. So now this is a bullish engulfing pattern, which is very close to this SMA 20 SMA, and the prices are, see, uh, all our parameters have checked the tick box here, because your prices are at first level, and then is your 20 SMA, and then is your last 200 SMA. So this order is working according to our rules. So now one more important thing which I forgot is, and this is the most, okay, this is the most. So whenever you have a rising, okay, rising 20 SMA, okay, it's going to be this rising 20 SMA is going to add more value to this. If you see a downside momentum, again I'm telling you, if you see a moving average, which is, you see, in this case it is this moving average, 20 moving average is going down, okay, this is this slope of this moving average is towards the downside. So whenever you have see here, for example, here it is towards, here you see the moment is towards the downside, okay, and also you see here the movement is towards the downside. See here very clearly you can say that, see, even here the moving average is moving towards the downside. So whenever you have moving average uh, that is going towards the downside, you cannot take this action. So for this to work, you need to see the more rising your 20 EMA is, the better this strategy is going to work, and it's going to create wonders, because 20 SMA is best in identifying the trends. So whenever you see a moving average which is a kind of like this, if it is very slow, okay, if it is rising high, then it means the trend is very very strong. Okay, you cannot ignore the fact, okay, you cannot ignore the fact that the moving average is either rising or it is sloping towards the downside. So in this case we have this pattern, okay, we have the prices as first, and we have the moving average 20 as the second layer, and then the third in the order is the 200 moving average. Everything worked, and we here we have the bullish engulfing pattern closest to the 20 SMA. So in this case, if it is touching also, it's fine. Either of these two candles, if they are touching, it's fine. And it is also not sloping towards the downside. You see here, from here it started rising. From here it started rising, and from here, okay, before that it was towards the downside. Okay, but here it's here from this point, okay, from this point it's slowly started rising. Okay, so this is the place where you will look to take an entry into the closing of your engulfing candle's second candle. So this the engulfing candles need two candles, right? So here in the second candle you would enter right into this candle when this candle is about to close, that is you can enter into the last 5 seconds and be in the trade as long as you see this line is steadily rising, or you see you can stay in the trade as long as this line is rising, or you can see, you can wait, there are a couple of ways to exit. Now this is the place where, now see, at this stage you note that, see, this line, this moving average line is very steadily, okay, looking towards the upside. The slope is very high, the angle of this line is very high. Now this is the time where, if you want, you can go to your settings and unlock your, excuse me, unlock your first SMA, which is a 9 period moving average. Now you can wait to see a close of the price, not these whipsaws, okay, not these whipsaws. Here you see a candle which is coming below this green moving average, and then again going back. No, no, definitely not, no. Okay, so you should wait to see a close beneath this. This is one way of exiting, okay, if you are someone who want to take less risk, or if you are someone who want to take larger risk, then you can wait until you see a close of this price below this blue color line, below this 20 period moving average. Okay, I hope you understand. Okay, first thing I'm again repeating so that you know the concept better. Okay, so here, first of all, you need to know what an engulfing pattern is. Only then you can trade this. So first logic is you need to have these two plotted, 20 and 200. If you only take, you use the third the moving average only if you are a very less risk taker. So even if you want to take plot that third moving average line, I don't recommend you to have it right from the beginning, because that's going to create some confusion in the chart. What is most important is for you to look at the chart as simple as it is. So now what should you wait for? You should wait for whenever you are see the prices are trading above this 20 SMA, you should be alert. And then you should have the 20 below and 200 below the 20. This is the order, and then you should wait to see a formation of bullish engulfing pattern either close to the 20 period moving average or touching the moving average. Okay, now in this case, you can you take the trade into the second candle's closure, that is just before the candle is getting closed. Excuse me. Don't come to a quicker conclusion that before the candles close, assuming, see, if you are 2 minutes away from this candle's closure, then don't take an action there. Consider this cannot be a bullish engulfing pattern. Only after I close, you know that this is a bullish engulfing pattern. So don't take any decisions in the live candle. Always enter into a trade during the candle's closing period. Okay, so just before 5 seconds or 3 seconds. Okay, nothing beyond 5 seconds. Okay, in 5 seconds, this entire scenario is going to change. So if you can even enter into the last 2 seconds, that's even better. Okay, and even the most important point about this is you need to see a rising line. You need to see a rising line, not a downside momentum of this 20 SMA. You need to see a rising 20 SMA. Okay, not even a flat. If it is flat, it's fine, but uh, at least a slight increase. You see, here you can see that it was in the downside momentum until this point. So from here, it slowly started rising. So this is fine. This much of the moment is fine. But whenever, as you are in the trade, this 20 SMA, I cannot tell you the importance of this, because it is the most efficient indicator, because it is going to identify the trending markets. Whenever you see a rising line like this, which means that prices are trending. Okay, so if you have any doubts, please type in the comment section so that we can answer your queries. Any kind of doubt that you have, you can ask us in our comment session. And see, this is how you see in this moment. For example, we thought of entering into this candle, right? We thought of entering into that candle, right? You see from there, this is just as day before yesterday's the last working day of bank nifty, that is December 15th. You see the kind of momentum that it gave. 275 points in one single trade. You don't have to pay commissions. Okay, waiting I'm taking multiple trades in this. Instead, you can stick to this strategy and make the best use of your candlestick pattern and also your moving average. Okay, so I hope you understood. Let's look at one more example. Okay, if we can find something. See, this is not an engulfing pattern. Okay, so yes, here no, it's really, this body is low. We need to have body side by side, so that is not. I'll tell you what how bearish scenario is going to be. Okay, let's look at yeah, here. Here you see here you see on December 8th of 2023 in bank nifty 5 minutes, again, see, we have all our parameters working here. See, this is an engulfing pattern. First thing is, prices are above your 20 period moving average, and then you have the 20 period moving average, and then you have the 200 period moving average, and then you have the bullish engulfing pattern coming at near the SMA. Okay, and then you have, okay, from this point, if you notice, then from here you can see that this moving average is kind of started rising. Okay, let's see how much of this has resulted in this trade. Okay, so see here it has given an exit. So from here, okay, it has even, see, till the day's close you have seen 230 points, and till next day you have seen 307 points. Okay, here if you want to activate that 9 period moving average and see, in that case, okay, you would have exited here at this candle. Okay, in this case you would have made 384 points. So it all depends on where you want to exit. So if you want to run with the trend for a longer period of the time, you stick with the 20, or if you want to quickly take your profits away, and then in that case you can use the 9 period moving average. So this is the another example of the bank nifty. So you see here again, you see here again there is one more. So in this case you see from here, okay, prices have gone. See from here, from this is an engulfing candle, this is a 20 period moving average, this is a 200 period moving average. From this the momentum was there, okay, and but you see according to 20 earlier, okay, so according to 20, so this is not given a very strong, because it is only you are entering there and you are exiting here. Okay, so it is almost at no profit no loss. But if you activate, if you activate the 9 period moving average there, then in this case you would have benefited from there. Okay, from here you would have benefited till here, that is 142 points. Okay, I hope you have understood the concept of how to use the 2200 engulfing strategy. So now what we are going to do is look at the bearish version of this. You might have already guessed, bearish version is nothing but the reverse version of this. All you have to do is change the order. Okay, so now you are looking at a bearish, which means that first you need to see a 200 SMA, and then you need to see the 20 SMA, and then you need to see the prices there, and better you have a 20 SMA, okay, towards the downside, sloping downside. And now you should have engulfing close to the 20 SMA, or touching it, or touching it. That's it. That's it. No more confusion. That's it. No big deal. Okay, so let's look at a scenario like that. So where is it here? This is not the right location. This is not the right location, because we are not seeing the order. The order is wrong here. See here we have okay, this is not the order. First you need to see a 200 period moving average, and then the 20, and then the price. That is the right order. Okay, so let's look at, yes, 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 here, here, look at it, look at this. Here we have, this is lightly skeptical. So whenever you have a situation like this where you are seeing a scissor, this is called a scissor situation. So whenever you see a scissors at a 20 and 200, here, even here you can enter. In fact, this is the most important location, because you are seeing the 20 period moving average coming and crossing this 200 period moving average, which means the prices are below, which means that 200 period is coming above this after this candle. Okay, and also which means that the 20, the 20 SMA is sloping downwards. Okay, so this is an excellent situation. So in this, for those who are towards the entry level, those who are not sure about this, in the next candle they would have seen that 200 period above, 20 sloping down, this 200 period above, 20 sloping down, and you see a bullish engulfing pattern already there. You can take this as confirmation candle, and you can also enter there if you are not so sure about this crossover. But those who are sure, those who are confident about this scissor position of 20 and 200, here you can enter and then see the kind of momentum that it has created from this candle, the 1325 candle of December 12, till the close. You have seen 171 points, and the next day immediately you have seen a gap up opening at 19, you have seen a gap up opening above this 20 period moving average. But you should not panic with this. Okay, you should wait for the close above this, not the opening. So that happened here, which is 230 points. If you want, if you want to be safe, we could have activated the 9 period moving average, then we could have exited somewhere here. Even that is not less than 250 points. Now, where should you have your stop loss? Simple. For if it is a bearish trade, Okay, you the bearish engulfing pattern where you have identified, the top of this candle is going to act as your stop loss for this entire trade. You will exit no matter what. You will exit whenever you see a price is getting closed above this, not just a whipsaw, but a price is getting closed above this. So look at the kind of risk versus reward ratio this pattern is creating. So if I take a short trade and if I plot it here, okay, and if that is your risk right above that, and you have seen okay, a trade which is continued almost till there, okay, almost till this level, right? You are seeing a risk versus reward of 8 times, which is massive, right? Okay, so if you are identifying, if you have unlocked the 9 period moving average here, if you have unlocked the 9 period moving average here, look at the, okay, this is the close. See, now you are seeing 8.8% of risk versus reward ratio. This is huge, right? So similarly, if you want to have a stop loss for your bullish side trades, okay, if you want to see stop loss for your bullish side trades, simple again, take the bottom end of your, see, if this is in this chart, these two put together is called an engulfing pattern, right? So now all you have to do is take the bottom most point of your engulfing pattern as your stop loss. That's it. So in bullish scenario, the bottom end of your engulfing pattern, if you see any close beyond this, is going to work as stop loss. And in the other scenario, in a bearish scenario, you're going to see the top of your bearish engulfing pattern as your a stop loss, not just a whipsaw close above that. So that's it for this video. I hope they have understood the concepts for both bullish and bearish engulfing pattern. Remember, this is going to act as wonders if you are patient enough with the markets. If you are patient enough to identify this pattern, okay, then you'll definitely see a success with this particular strategy, because it is a combination of a strong indicator which is very strong to identify trending markets, and this is a very strong reversal pattern. Okay, so we are combining the both price action with the indicator, standard indicator, and then we have created this. So if you have any doubts toward this uh, strategy, kindly let us know in the comment section so that we can answer it as quick as possible. And please make sure that you also watch our engulfing video. That is going to give you a lot of information about the engulfing pattern. Engulfing pattern is not just engulfing the previous pattern. There are certain factors which are going to increase the importance of the engulfing pattern and make it even stronger. Okay, so that's it for the video, guys, and hope you have subscribed to our channel. And please hit that bell icon so that you are will be notified whenever you we launch a video on any technical analysis. And we do a post market analysis every day on Nifty and Bank Nifty. So please stay tuned, and I request you to not just watch this video, and but also you do your own back testing on a 5 minute chart. This is going to work in all the time frames, so you can take whichever time frame is convenient for you. So here, okay, what is important is not just knowing the strategy but doing a back testing. I request you to do back testing at least for 3 to 6 months of period. Only then you will become confident and start watching this pattern in the live markets and trade only one lot until you become consistently profitable for 3 months, and then take this strategy forward. I hope this is a most valuable video. I hope you also watch it with again and again, with to get the most of it and understand the concept. That's it, guys. Thank you so much, and please do subscribe to our channel, and let's see in our another video. Thank you.